So, Jeremy, you wrote this fantastic book called Ground Rules, which covers basically a lot about Warren Buffett during his partnership years. Perhaps you could give a quick synopsis of what you found the value of in terms of covering this aspect as opposed to more of his well-known letters from Berkshire Hathaway.
Well, Peter, the book is really about Warren Buffett's time in 1955 to 1970 when he was running a partnership. What started as just a small group of 7 other friends and family members from whom he decided to manage money for. And he wrote them annually to try and help them understand how he was thinking about the markets. You know, he never really talked about explicitly what he was doing, very secretive, and no one really knew what was in the portfolio at any given time. But the letters were really written with the intention of describing his process and his methodology. And so I found them very rich and very interesting from the perspective of, you know, here's a young Buffett who could go anywhere and do anything, not at all constrained by the size of his funds the way he is today. Mm-hmm. And then 2, you know, it was a period in his life where he really transitioned from, you know, a pure Grahamite, you know, as the star pupil of Ben Graham, obviously the father of value investing, and really, you know, migrated more towards a quality compounder. So, you know, the book is about really, it's really carved into 3 sections. One is, you know, understanding the philosophy of markets. 2, you know, understanding some of the methods of operations, the different kinds of investments that he was making. And then 3, you know, some musings about, you know, taxes and the value of being conservative versus conventional, and, you know, sort of other topics that he liked to address and use as tools to teach his clients. Yeah, well, I'll tell you, you know, there's this great quote from Buffett that surfaces all the time, which is something along the lines of, you know, if I was running $1 million or $2 million today, I could make 50% a year compounded. Yeah. And, you know, he goes as far as to guarantee it, right? Yeah. And, you know, I get asked all the time whether I think that that's a plausible sort of idea in today's markets. And what I like to remind people is that, you know, and we get from Buffett in this time some case studies, which are really wonderful and rich. It's almost like you get this opportunity to look over Buffett's shoulder as he's investing. But, you know, there's a couple cases where he massively concentrated in micro caps. So, you know, the first one was a company called Sanborn Map Company, and he had almost a third of the partnership assets in that, you know, in the late 50s. And it had a, you know, I think $1.5 million in book equity. Right. No, it was tiny, you know. And then he came around and did Dempster Mill, which was in the early 60s, which is also a hugely concentrated position he took control of ultimately. But, you know, that was also, you know, in the single digit million, you know, market caps. So if you think about today, the inflation multiple would be like 7. So, you know, if it was, you're talking about like a $30 or $40 million company today for these guys, and think how small that is relative to, you know, what most people invest in. So these were underfollowed, tiny, sort of obscure, off the radar companies in which he was able to find and, you know, invest in. And I think I would imagine that he would do something very similar today, which would be to go where, you know, most professional investors can't, and, you know, look for some really mispriced assets. Yeah, so really during the partnership, we see a transition, and, you know, you go from the early years, which is the cigar butt period, where, you know, whether it's a Dempster Mill, which is a windmill implements company in Beatrice, Nebraska, that's on the verge of bankruptcy. And, you know, he sort of swoops in and repositions the assets and works the inventory down. I mean, time is not the friend of a business like that, right? And basically what he's doing is buying a company or an asset that is, you know, priced as if it's on the, you know, going out of business, and then he resuscitates it into just a mediocre business, and gets the profit, right? And so that's the treadmill lifestyle of a Ben Graham disciple who's following his teacher to the letter, right? But Buffett migrates away from that over time, and at the end of the partnership, those final years, he had 40% of the portfolio in American Express.
Yes.
Right. So here's the almost I see the period as sort of him sort of limping into the quality compounders, and really and he had Disney as well. He had owned 5% of Disney during the partnership years. He also bought National Indemnity for Berkshire Hathaway during the partnership years. So we do see these migratory moves towards quality compounders, but it's slow, and I think it's really in some ways he had the best of both worlds, because both American Express and Disney were not only good companies, but they were extremely cheap at the time that he bought them. Yeah, so the brilliance in my mind of Buffett in these early years is that, this was the time where it was the concept of that Graham had taught him, which is that, investing is best done when it's most business-like, and business is best done when it's most investment-like, really, I think is solidified for, Buffett in this time period. As an investor in a partnership, general partner, he was charged with deploying the funds that he had under management to their highest and best use. And then, he took over businesses like Dempster, right? And also took the same philosophy, which is deploy the assets to their highest and best use. Ultimately, I think he realized quite early that all capital is fungible from one form to another. So, having a business with capital and inventory that isn't earning an acceptable return, that capital, that inventory can be repositioned to cash, right? It can be sold. And then that capital can be redeployed, like to buy stocks, like he did, with the Dempster piece, right? So the whole idea is that, business is just a pile of capital ultimately, and it's the job of the manager, whether it's a CEO or a portfolio manager, to deploy capital, to its highest and best use, and then to redeploy capital in the form of earnings that comes off the assets that are in place, also to their highest and best possible use. So in the case of Berkshire, you had a business that was screaming for capital investment from its managers, but Buffett could not earn a sufficient return on that incremental reinvestment, right? And so he didn't do it, and he didn't ever see himself as, quote, in the textile business because he owned Berkshire Hathaway. He was in business, right? And the distinction is, go after and deploy your assets to their highest and best use. So he took money out of a bad business, which was Berkshire, and redeployed it into a good business, which was the insurance company, National Indemnity, that he bought from Jack Ringwald in, I think, 1968. Right. So, one of my favorite parts of the partnership letters that Buffett comes back to over and over again is his definition of risk, right? And, oftentimes in modern day finance, we think about risk, or risk is thought of as beta, right? And that's how we quantify risk. And, it's the degree to which a stock squiggles, over a given trailing period of time that determines its beta. And that's often the way people think about risk. And Buffett thinks about it very differently. He thinks of risk as not knowing what you're doing.
Yeah.
Right. And so you have to have a real understanding of a business to be able to value it.
Mm-hmm.
Right. And if you really don't understand it, then you can't value it. And then I think what happens is, you look to the market to tell you what something's worth. And as soon as you do that as an investor, I think you're dead.
Mm-hmm.
Right? Because at least under the framework that Buffett operates in, right? The market has to be there to serve you. In other words, offer you up enticing prices from time to time, mm-hmm. but it can never really be there to inform you. Mm-hmm. Right? And so when it comes to tech or healthcare or anything for that matter, and by the way, this will be different for everybody.
Right.
But you have to know the limits of your own circle of competence. Yeah. And, I don't think that Buffett will ever feel like there's a time where he has to do anything. Mm. He couldn't find anything that was suitable to him in 1969. And so he closed the partnership as opposed to compromising on his principles. Right. And I would suspect that he would do the same thing again. I mean, so it's not really about being forced into anything. I think it's just a question of his own comfort level. And the question ultimately comes down to, is this a bond? Yeah. Right? So you go back, I think the first article he ever wrote for Fortune magazine was in 1978, and it was called How Inflation Swindles the Equity Investor. It's a fabulous piece that he wrote then. And in it, he talks quite extensively about how similar equities and bonds actually are. Right. And that, most companies over time mean revert in their returns on capital, et cetera. But I think Buffett's looking for, at least back in the partnership years, I think he was looking for a 15% equity bond. Right. So, if the current yield on distributable earnings over the price that he had to pay was something in the nature of 15%, and he thought that the company sort of would be able to generate that kind of earnings in perpetuity, he was all for it. Right. And so I think that's just the struggle with some of the technology companies, because the pace of innovation is so fast. Now, your point's well taken that maybe some of these are maturing, and maybe that's the reason why you are seeing them in a name like IBM today.